...2022 should see fireworks for the markets. That is according to our next guest, Lobo Tiggre of the Independent Speculator, and he'll be clarifying exactly what he means by that and which markets will be affected most. Lobo, welcome back. Happy New Year. It's been a while since we spoke. How are you?
Happy New Year, David. I'm happy to be back, and I congratulate you for having the most boring newsletter writer back on your show, Mr. I don't do predictions. So,
okay, well, I don't know who that newsletter. I don't know who that newsletter is that you're referring to, but you're for sure not boring, and we'll for sure get your exciting predictions for 2022. Let's talk about today's news. Fed Day. Fed statement came out. Now they are indicating a higher pace of tapering. So the markets reacted as some may expect, or some may have been surprised by the market reaction. Gold was down after 2 p.m. The U.S. dollar shot up, which is partly why gold came down. Now the stock markets were down as well. Lobo, so people were talking about how the stock markets were able to absorb higher rate hikes. Does that still seem to be the case?
Yeah, I've been watching your interviews at the year end, year beginning here, and everybody looking forward. And it seems like a lot of investors, Mr. Market metaphorically, thought he knew what was coming. They thought they were ready for a more hawkish Fed. And today wasn't Fed Day exactly. FOMC already met. This was the minutes for December. But it showed, not just, we're going to continue to taper and we'll consider raising interest rates. They're talking about balance sheet reduction. And that's what really sparked things last time. So first, to our previous joke, I will go out on what is a limb for me. I don't like to make these bold predictions. People make clickbait headlines to make a sale. I think that's irresponsible. But I feel really strongly on this particular one. I think this is jawboning. I think the powers that be, they understand they have to do something about high inflation, which wasn't so transitory after all. So they're trying to do as much as they can with the jawbone and hoping that they don't have to actually do that much with accent. So my limb here, David, is that, a balance sheet can be abbreviated as BS. That stands for something else. So my prediction for 2022 is that we will see no reduction of BS from the Fed in this year. I think they will taper.
Wait, no reduction of BS or more addition of BS? What are you referring to now?
Well, we'll see. I mean, if the wheels come off, yes, we could see more BS in both senses of the term added. But just to summarize, David, what I'm saying is there's a lot of talk, there's a lot of prep, there's a lot of sense of, the market's ready for tightening. The market knows we have to deal with inflation. I don't think that's true at all. I think the market thinks it knows, or some investors think, but every time something like this happens and we see this reaction, that tells me that there's a lot of nervousness out there. I mean, people know that valuations are stretched, and a tighter monetary policy can't be good for those things. Everybody knows this. Nobody's going to want to be the last in the room. I think there is a serious chance of a major market reversal this year, as well as no reduction of BS from the Fed.
Okay, I want to talk about that, of course, but first going back to gold's reaction, I'm more curious as to how things react to the news and the actual news itself. So gold went down, the dollar was up, the stock market, as I've discussed, was down. It doesn't seem like gold's acting as a safe haven, right? Going back to our previous discussions, gold has at some points reacted stronger to the dollar than at other times. Today seems to be that case. It's reacting to the dollar and not acting as a protection, a hedge against equity volatility.
Yes, this is actually something we've talked about numerous times over the last year, how gold's 50-year relationship with interest rates being the number one driver. Of course, it responds to many things, a war or all kinds of things. But the number one driver since we went off the last vestiges of the gold standard in 1971 has been interest rates, and particularly real interest rates. And over the last year plus, we've seen gold responding more directly to the dollar's movements, which is an aberration. But let's pull back to the bigger picture of just the day, David. We've talked about this before too. Gold tends to anticipate. It tends to lead inflation. So I think it did, for all the people that are unhappy about what gold did in 2021, I think it did a fantastic job of signaling inflation in advance in 2020. Now, why isn't it doing that now? Well, I think a lot of investors and traders out there think that we already have the inflation. This is it. 6 pushing 7% inflation. This is what gold was signaling. And we're near peak inflation. I've seen headlines saying that. With the kind of people who read my newsletter and most of your audience and the people who go down to the mom and pop coin shop, they don't see things that way. But these traders in Chicago, New York, London, these places, I think they're still drinking the Kool-Aid. I think they still think, some form of the transitory yarn is true. That we've peaked. It's gonna be a correction, but it'll be okay. So until that changes, I don't think gold will be the kind of signal we're hoping for. But here's the big takeaway. For all that gold has gotten whacked, nonsensically whacked, every time there's been an inflationary headline over the last year, because the Fed was going to tighten and that was going to be bad for gold. Now we have, just 30-year type record numbers in CPI and PCE, huge headlines. And we have the Fed minutes now talking about not just, the taper and not just bringing rate hikes forward, but actually reducing the balance sheet. And I don't think they will, but they're talking about it. These are huge headline factors that over the last year, this unusual year, have really been bad for gold. So my question is not, well, why isn't gold doing better? My question is, why isn't gold going down? Why aren't these factors that have whacked gold so hard over the last year not pushing it down? As you and I speak, it's still over 1,800. I think that's quite striking. I think it's a sign of a change in the air. I think there is something different in the precious metals or monetary metals space. Now, exactly what that is, that's where people, they make up all kinds of explanations. I could make one up for you. I think we'll see. But I think it's a significant signal that people should be watching. Something has changed, David. The whack-a-mole hasn't done its job this week.
Okay, so let's talk about that whack-a-mole. Now, I'm getting the sense that you disagree with the traders in New York and Chicago and London because they're projecting transitory inflation, which you disagree with. Okay, so assuming the gold market at large has been wrong overall about their inflation outlook, at what point will they start to realize that they are wrong? Do we need higher inflation still?
Not necessarily. I think you can have it reduce. We get maybe a 7 handle next, maybe not, and it goes back to 3 or 4. That will seem like a reduction. It might seem for a while that, oh, look, the powers that be have this under control. What the Fed's doing is working. It's down from 7 to 4. How great. But 4 is still extremely high. It's double their so-called symmetric target of 2%. And by the way, even 2% inflation, if we had that still erodes your purchasing power of your dollars, significantly over not such long periods of time. So I think persistent high inflation, despite what the Fed's doing, ultimately shows that the emperor has no clothes. But as far as, I won't give you a date. I'm not going to do that. But I will give you what to watch out for. Is watch for when the jawboning turns into reality. Let's see what the Fed actually does. If they finish the taper and they don't immediately jump on with rate hikes, I think that'll be a big signal. And if they do jump on with rate hikes, but real rates remain strongly negative, maybe even more negative, then that will show the emperor having no clothes. And the big one, you talk to, I think, some of the more responsible people out there, the Lynn Aldens of the world, and some of the really thoughtful people out there, is when it becomes evident that the Fed needs to do more, and they're not, like, say, because of the enormous debt that the U.S. government has and how unmanageable that becomes at higher interest rates, I think that's when really it becomes evident that the emperor has no clothes. Like when everybody has this sense that the Fed should be doing more and it's not.
Okay.
It's behind the curve. Everybody knows it's behind the curve, and they're denying it. They're not changing their course. I think that's when things change, David.
All right. Well, you did promise the audience you'd go out on a limb today. So barring the fact that you're not going to give a date, suppose this happens at some point in the future, that scenario that you just described, what will happen to the gold price?
I think it goes up. I think history is on the side of gold going way up. I think it takes silver with it too. We've talked about how silver seems to be becoming unglued from gold.
Yes.
But for now, it's still regarded as a monetary metal. It is the word for money in many languages around the world. And whatever may happen to silver in the future, right now, if there's a sudden sort of, that heart-grabbing moment where there's fear, that people want a safe haven, I think it's very likely that silver will track with gold. I appreciate you not putting my feet to the fire on a prediction of both what and when, but I do think it happens this year, David. I don't see how the pretense of the emperor having this beautiful clothes of being in control of inflation and the economy and everything, I don't see how that lasts this year. Okay. At some point this year, that narrative comes as unglued as the transitive one.
All right, so sometime this year is transitory. Sometime this year is good enough for most people. Now, what about the magnitude of the rise? Can you give us an estimate?
I think new all-time nominal highs are the very least we can expect.
Nominal highs, okay. You stress nominal. Why not in real terms? I know in the real terms, I think 1980.
I'm not sure what that number is today, but in real terms, I think that takes us close to $3,000 gold. Nominal terms is easy. Real, it depends on the level of panic.
Nominal terms is easy. Can I quote you on that?
Yes, you can.
All right, fantastic. Well, that's only $200 from here. It is.
Yeah, that's not so far out on the limb.
It is not. Although people have been not to put you or anybody in particular, but a lot of people have been saying it's only been $200 for a long time. Gold's been stuck in a range for a very long time, and I think what investors want to know right now from you, which you've discussed already with me, is it's a catalyst for this push, because everybody is expecting gold to push another $200 higher. It's not going to take much, but the question is what, right?
Sure. Well, I think that's what we just answered. In my view, it is the perception falling away that the Fed actually has control of this, that inflation is such an easy, we got the tools. Every time Powell talks about, if inflation rears its head, we'll take care of it. No problem. Doesn't even be, I remember Bernanke, when he was asked hard questions, he had this vein would pulse in his forehead. And Powell doesn't do that. He seems like quite the cool cucumber on this. But I think it's Fed BS, and I think that will become evident. I think that's the catalyst. When people are like, holy cow, this is real. It's not going away. You cut off the head of the Hydra and two more grow back. That's the catalyst, David.
Okay.
There could be something else. There could be a war. There could be something, but those are not predictable. Those are true black swan events. And then they could be tailwinds, but we don't need any of that. I think the Fed being revealed as not having the clothing it's regarded as having will be enough.
Well, let me put your feet to the fire on some other things besides the gold price. Let's talk about inflation first. So we know you don't think inflation is transitory, but that could mean that either inflation has already peaked at current levels and will maintain its current levels for some time, or you think inflation is going to go higher. Which of these scenarios is more likely?
I think inflation will. The monthly spikes, may go up and down. I think we're going to see persistent high inflation, and how much higher? I expect it to peak and roll over a bit. I'll be honest. Okay. I don't expect it to just keep going up and up and up forever right now. I don't think we're there yet. But if the Fed's response, and if, writ large around the world, if government responses to high inflation actually do create a recession, which is the traditional cure for high inflation, I just don't see any of today's governments or the populations being willing and able to take that pain. So I think the governments come rushing back to the rescue. They do a U-turn on their policy, and they put more gasoline on the fire. So what I'm saying is I do expect inflation to go much higher, but I can see it correcting, or I can see it rolling over first and then going higher.
Okay, so what about interest rates then? Can they being the Fed, can the Fed raise rates 3 times? As the dot plots have last predicted?
Well, remember the dots are changing. We're getting some new Fed members, so I'm not sure how much weight to put in that dot plot. And if it's 3 times, but they're 0.25 increases, that's peanuts compared to where they need to be. So I don't think that's highly meaningful. What things to watch out for is do the rate hikes come forward? Are they bigger than expected? Did they do a 0.5 at once or bigger? Because of persistent high inflation, that would really shock things. And if the market can deal with a 0.5 or 0.75 rate hike all at once, I will be very surprised. That's a forward-looking statement for you in the audience there, David.
Well, Lobo, going back to the nominal rates going higher, it is significant insofar as that it affects the gold price direction. Remember that gold reacts to the direction of real interest rates. So if it stays negative like it has been, but it doesn't really move, then gold doesn't really move either. But let's suppose they do raise interest rates by 3 times 25 basis points, so a total of 75 basis points. It may not seem like much, but if inflation stays the same at current levels, like you've said it could, then that means that implies that real interest rates will indeed tick up from here, which could put downward pressure on gold, right?
It could, and directional changes do matter. But I think in the current context, where people can see that the situation is, dire. I mean, we've got 30-year highs in CPI and PCE. These are big numbers. They're momentous, and I think a 0.25, 25 basis point hike. I don't think that's really going to impress people a lot. And if we get 3 of them, it wouldn't be 3 right in a row, or it wouldn't be 0.75 all at once.
Right.
If the Fed were to actually get so aggressive or so concerned about inflation that they did do a 0.75 all at once, I think that Mr. Market would not be ready for that. I would be very surprised if we didn't have a severe adverse reaction in the markets if the Fed were to do something like that. Whereas 25 basis points spread out over the whole year, that's more digestible. But that's not what the headlines are talking about now. They're talking about a more aggressive pulling forward of these rate hikes.
Yes.
I think that could really rock the boat. And this isn't just, theoretical or some financial news that those fat cats on Wall Street worry about. Inflation affects people's everyday lives in very material and serious ways. Right now, as we talk, there are riots in the streets in Kazakhstan, and the government has resigned. Now, this may seem like a far-off place. Who cares what happens in Kazakhstan? Well, they're the largest exporter of uranium in the world. They also export petroleum products, other energy minerals, and they're right between Russia and China. This is an important geopolitical event as well. So this is big stuff, David. And I think the potential here for fireworks, as we started this interview mentioning, is real, and we're seeing it, unfold on our screens now.
Okay, why aren't people rioting in New Mexico where you live? Why isn't the greater population there taking up arms, taking up slings and arrows against a sea of trouble, so to speak, against inflation and other things?
Because they're still convinced that the Fed can fix it. They have the tools. Don't worry, Uncle Powell will kiss the boo-boo and make it go away. Mm-hmm. And that's the catalyst I'm calling for, David. When he kisses the boo-boo and it doesn't go away, I think that's when things really get exciting.
Is that a technical term?
And by the way, there may not be many riots in the streets in a suburb here of Albuquerque, New Mexico, but we've seen plenty of violence in the streets. I mean, smash and grabs up and down throughout California. What is that? And people beating up stewardesses and fellow passengers on airplanes? I mean, this country this isn't normal. This isn't the America I grew up in, at any rate. So I do see signs of stress. And it's not just lockdowns. I think, people's lives are being messed with, David. And there's a sense of that. And it could boil over.
Yeah, very odd times indeed. Okay, let's talk about I want to talk about silver now. You mentioned that silver and gold should go up together. A divergence in prices is something we've seen in the last year. Why couldn't that continue this year?
I think it could, but just look, like in 2020, when we had the crash in March, gold and silver both got whacked. And after they came screeching back up again, gold rose a lot and silver didn't. They had a very different response, but directionally they were the same. So I think that until really not just people in the US or Europe or whatever, but until people around the world at large really decide that silver is just an industrial metal, it will generally track gold. We'll see more volatility in the gold-silver ratio. We'll see patterns that held true before may not hold true anymore because there is this greater industrial side to it as well. But at least for now, the next near-term couple years, I don't see major moves in gold one way or the other, up or down. I don't see those leaving silver out.
Okay. Now, you mentioned that gold could breach new nominal highs. Silver's got a bit more room to climb, right? Now, the nominal high, remember, was $50 an ounce. So is that, what do you think? Can we get there this year?
I think we could, but I think what that would take, what makes silver really go vertical like that is when you have gold and silver, monetary metals in a rising trend, and then you have some kind of threat to the supply, like the Hunt brothers is a threat to the supply, or in 2009, 2010, the post global financial crisis economics keeping silver supply from base metal mines under pressure. That combined to make rising prices insensitive to supply, and silver spiked. So we could see that if we get an actual recession this year, and it's funny to see how that R word is popping up in the headlines more. And by the way, with the R word in the headlines, sorry, sidetracking, but there's a point here. I'm also seeing the talking heads on mainstream financial media, not just Kitco News, of course, but mainstream financial media starting to say, when we're advising clients to put a little gold in there, why not? That's really significant.
What is the R word? Sorry, I missed this. What?
Recession. There's more people talking about recession because that is what you're supposed to do. That is the Volcker bitter medicine. When you have high inflation, which is supposedly, due to an overheating economy, you need to put the brakes on the economy is the mainstream understanding of how you deal with that. So what I'm saying is if we've got high inflation, we've got monetary metals heading higher accordingly, and then you have some form of recession, you have an industrial cool down, and that impacts mine supply because most silver, as I think most of the audience should know or knows, it's a byproduct of big copper mines, lead zinc mines. Even so-called silver mines are really, there's still lead zinc mines with a very big silver credit. By volume, they produce more base metals than anything else. And those base metal credits are usually important. It's extremely rare to have a silver mine that could make money even if you just threw away the lead and zinc and, or copper or whatever. So this is too long-winded an answer. I'm saying that if we have that circumstance, David, where you have rising monetary prices and you have a supply threat or even the perception of a threat to the supply of silver, silver could absolutely go nuts. I think you could absolutely see a new nominal all-time high.
Let me ask you this:
if gold and silver, take a bigger breakout to get a real price.
Yeah, sorry, I cut you off there. So it will take a real breakout. What's the new all-time high you're predicting?
Plus 50 would be a new nominal. A real
sorry, no, I don't mean a new all-time high.
It's close to 200.
Okay. So Lobo, what's a more conservative upside target? Because like you said, $50 would take a lot.
It would, except that silver is so volatile typically compared to gold. So let's say we have a more conservative target, plus 30. That's not such a stretch. We were close last year. We could easily go plus 30. The excitement that would generate could easily push it higher. And if it breaks 40, then suddenly people start paying more attention to it. It becomes a self-fulfilling prophecy. Who knows? That's not a solid trend that I feel comfortable betting on. But I'm just wanting to point out that a conservative upside could actually lead to an unconservative upside.
Sure.
But I think 30 plus is very easy to see. And getting in the 40 range, I think, could actually be sustainable as long as the monetary and fiscal environment stays the same.
Let me ask you this more existential question for the markets, I guess. Now, you mentioned that gold and silver should be perceived as monetary metals. Well, if they were a monetary metal, would supply really matter? Suppose tomorrow, just hypothetically, mining for all silver and gold were to cease. It would just stop. We'd have no new production and new supply of gold and silver. Would that have any material impact on the price? Because think about it, if the price is driven by monetary means, supply shouldn't matter, or am I wrong?
You are right and wrong. It would be completely different for gold and silver.
Okay.
As I'm sure many of your guests have said before me on the show, most of the gold ever mined in history is still in purified form in one vault or another somewhere, whereas silver is consumed, especially nowadays. There was just a big Roman hoard discovered in a river of some thousands of silver coins, but that's extremely rare. Silver is consumed now. And people make a big deal about how there's so little silver in the COMEX warehouses and so on. I'm not persuaded by those arguments. It's consumed. It is also an industrial metal.
Yes.
So given that it is literally taken off the market and put into cameras or into other things that puts it back in the ground in a landfill eventually in a form that's very difficult to recover, it will be very different. You stop the mining in gold, it might have a knee-jerk reaction, but it would matter more, how people felt about the fate of the dollar and so on. Right. Silver, you stop mining for silver, and it would be big.
Mm-hmm. That's a good summary.
Like palladium or something like that.
Yeah.
Going more expensive than gold just because it was a supply crunch.
Okay, that makes sense. Let's go back to Kazakhstan and we'll end it there. Kazakhstan, like you mentioned, is significant because it is a significant producer of uranium. Let's talk about uranium.
Sure. Obviously, big year for uranium in 2021. Let's go to Kazakhstan first, though, for a moment. There's been a knee-jerk reaction. Basically, all the uranium stocks I'm tracking, they're all in the green this morning by significant amounts. I think that's a little silly. I mean, there is a big unrest in the capital. That doesn't mean that mining has stopped. That the state-owned Kazatomprom is not, so far that we know, affected. Now, it could be. This could become something that would impact supply, but I wouldn't bet on that. The guy in charge, the top. We talk about the government's resigned. Well, that just means some ministers have resigned and so on. The guy in charge, he hasn't given up at all. But we'll see what happens. So I just want to put that out there. Let's not count our uranium eggs before they're hatched here. Just because there's upset in Kazakhstan, that doesn't mean that the supply is suddenly going to go away. No. That's one thing. The other thing, though, is just the lesson from 2021 is that before the advent of Sprott and now the Kazakhstan version of the Sprott Uranium Trust, that before that happened, we really didn't know how much secondary supply there was out there. We all had this feeling that it had been many years since the Japanese had been selling and then maybe wound down their selling of excess uranium supplies. But it's an opaque thing. Nobody really knew. Then along comes Sprott and starts hoovering up all the cheap pounds on the market, and suddenly we find out, well, gee, there really aren't that many people willing to sell in the $20 range or $30 range. So I see this as a changed market. That's the takeaway, David. I see this as a different market than we saw in previous years. And I think that will bring the utilities to the table to sign these long-term contracts. That's really been the catalyst, more than what happens in the spot market, more than what Sprott and Kazakhstan and even some of the miners are doing, buying pounds off the market. The real thing that needs to happen here is for the end users, the utilities, to sign long-term contracts at prices that make sense for uranium miners. That's the catalyst I'm looking for. And I think the changes we've seen in the market will bring that on. I'll be surprised. Here's my forward-looking statement to wrap up the interview with David for 2022. Lobo's big predictions. I'll be very surprised if we don't see long-term contracts at significantly higher prices that make sense for an industry that is still really insolvent at current prices.
What is that going to do for the spot price, though? Because if these contracts are negotiated under the table, people can just pay a premium on the spot, right?
Well, eventually they come out in the companies reporting, the public companies anyway, these things come out. So we'll see what these contract prices are. And, obviously the Camecos of the world, companies like that, they'll want to trumpet out, look at this, we got a new contract signed at $70 a pound or whatever it is. So we will know.
No, but I'm just saying, I'm not really sure how it works for the uranium market because it's a relatively opaque market compared to, let's say, gold and silver. So if I were, let's say, Cameco, and you were a utility company, I could say, well, let's negotiate. I'm Cameco. I'll buy uranium you buy uranium from me at $70 a pound, even though the spot price is $50. You're just paying a $20 premium. That's between you and me. That may not affect the market, right?
Well, they don't have to tell you until their quarterlies come out.
Sure.
And I'm not sure I've seen this, but if they had some sort of agreement of, hey, we don't want to push prices up, so let's have an agreement that we won't tell anybody what we paid, to try to keep prices down. The utility wants to try to keep prices down.
Yes.
So they may try to do that. But at the end of the day, it either comes out in the financial statements, quarterly or halves or yearlies when they come out, or you reverse engineer it. You look at their costs and your usage and you say, okay, how many dollars per pound did that work out to be? We bought this much uranium. Here's how much we spent on uranium, and we can work that out. Or here's our consumption. Here's our spending. So there are ways to figure this out after the fact, but there is reporting. You can look at Numerical, for example, and they report various sales and contracts and things. There is data out there. I wish it was better. I wish it was as transparent as some of the LME market trades and things. But it is what it is. But the answer to the question, though, actually, whatever the spot price does is really secondary. As a speculator, I'm not looking to stuff my mattress with uranium, right? I'm buying the stocks. So what matters to me is, are we able to get prices that make uranium mining profitable, that make these projects that we're exploring worth building? That's what I want to see. And that's what should light a fire under those stocks. Should, but the reality is
Lobo,
the spot price.
You're a silver stacker. Why not a uranium stacker? Come on, man. You got to diversify your stacks. But great insights overall. I thank you once again. And I'll look forward to working with you a lot more this year. Thank you.
Thank you, David.
And thank you for watching Kitco News. Stay tuned for more. I'm David Lin. Subscribe to our YouTube channel.